Imagine this. Two friends graduate from college at exactly the same time. Both are 25 years old. Both get decent jobs. Both earn almost the same salary. Neither of them is born into a wealthy family. At first glance, their lives look almost identical. But 35 years later, one retires with over $2 million in investments. The other, despite working just as hard, has almost nothing saved for retirement. So what happened? Did one friend win the lottery? Did one suddenly become a billionaire entrepreneur? No. The difference came from something so simple that most people completely ignore it. It's called compound interest. And once you truly understand how it works, you'll never look at money the same way again. Most people believe that becoming wealthy requires a huge salary. They think, if I could just earn $200,000 a year, if I could get promoted, if I could start a successful business, then becoming rich would finally be possible. It sounds logical. But history tells a very different story. Every year, there are professional athletes, movie stars, lottery winners, and celebrities who earn millions of dollars. Yet many of them eventually go bankrupt. At the same time, there are ordinary teachers, engineers, office workers, and nurses who quietly become millionaires before retirement. So clearly, income alone isn't what creates wealth. The real difference is how long your money is allowed to grow. That's exactly where compound interest changes everything. Think of compound interest like planting a tiny seed. On the first day, nothing exciting happens. A week later, it still looks small. Even after a few months, it doesn't seem impressive. If you looked at that tiny plant every single day, you might think, this isn't working. But underground, something incredible is happening. The roots are getting stronger. The tree is preparing for years of growth. Money works in almost exactly the same way. When you invest, your money earns returns. Then, those returns begin earning returns of their own. And after that, those new returns also begin earning more returns. Suddenly, your money is no longer working alone. Your profits start producing their own profits. That's the true power of compound interest. It's growth, on top of growth, year after year after year. Imagine investing just $100 every month. At first, it doesn't feel life-changing. After 1 year, you've only invested $1,200. Many people look at that number and think, that's too small to matter. But that's exactly why so many people never become wealthy. Because compound interest rewards patience, not impatience. The biggest gains don't usually happen in the first year, or the fifth. They happen decades later, when your investments begin growing faster than your own contributions. That's the moment when time becomes more valuable than income. And that's the lesson wealthy people understand better than almost anyone else. They don't just work for money. They let time work for their money. So if compound interest is this powerful, why doesn't everyone become wealthy? Because most people never give it enough time. They wait until their 40s, or even their 50s, before they start investing. Others invest for a year, see only small gains, and quit. Some panic during market crashes and sell everything, right before the market recovers. The problem isn't that compound interest doesn't work. The problem is, most people stop the process before it has a chance to become powerful. And this is exactly where the richest investors think differently. Because they understand one simple truth that changes everything. The earlier you start, the less money you actually need. Now, let's prove that with a simple example. Imagine two investors. We'll call them Alex and David. Alex starts investing at the age of 25. He invests just $200 every month into a low-cost S&P 500 index fund. Nothing fancy, no risky stocks, no crypto trading, just a simple investment, month after month. He continues until he turns 35. Then he stops. Completely. No more contributions. He simply leaves his money invested. Now meet David. David doesn't start at 25. He waits. He tells himself, I'll invest after I get promoted. I'll start when I earn more. I still have plenty of time. Finally, at the age of 35, David begins investing. He also invests $200 every month. But unlike Alex, David keeps investing every single month until he reaches 65 years old. At first glance, David seems like the smarter investor. After all, he invested for 30 years. Alex only invested for 10 years. Surely David should end up with more money, right? Surprisingly, that's not what usually happens, because Alex gave his investments something far more valuable than extra contributions. He gave them time. This is where compound interest becomes almost unbelievable. When your money earns returns, those returns begin earning returns of their own. Then those new returns start generating even more returns. It's like rolling a tiny snowball down a mountain. At first, it barely grows. But as it keeps rolling, it becomes larger, heavier, and faster. Eventually, the snowball grows so quickly that most of its size comes from what it collected along the way, not from how it started. Money behaves the same way. In the beginning, your own contributions do most of the work. Years later, your investment returns become larger than the money you're adding yourself. That's the moment wealthy investors wait for. They're no longer building wealth. Their wealth is building itself. This is why many millionaires obsess over one thing: not finding the perfect investment, but starting as early as possible. Because every single year you delay, you aren't just losing 1 year, you're losing decades of future compounding. That's why financial experts often say, the biggest cost isn't making a bad investment, it's waiting too long to make your first one. And yet, this is exactly where most people make another costly mistake, one that quietly destroys the incredible power of compound interest before it ever has the chance to work. The biggest cost isn't making a bad investment, it's waiting too long to make your first one. But here's something even more surprising. Most people don't lose money because they choose the wrong investment. They lose money because they can't control their emotions. Think about it. Imagine you finally invest your savings. Everything feels exciting. Your portfolio starts growing. You check your investment app every morning. Every small gain makes you smile. You begin imagining your future: a bigger house, financial freedom, an early retirement. Then, without warning, the market falls. 5%, 10%, maybe even 20%. Suddenly, those same people who were excited just days ago become terrified. The news channels start using words like market crash, economic uncertainty, recession fears. Social media becomes flooded with panic. Friends tell you to sell before it's too late, and that's exactly what millions of investors do. They sell, not because the investment became worthless, but because fear became stronger than logic. This happens in almost every market downturn. History repeats itself again, and again, and again. Yet if you study the world's greatest investors, they react very differently. When everyone else is panicking, they remain calm, because they understand one simple truth: a temporary market decline doesn't change the value of great businesses. If companies continue earning profits, innovating, and growing, their value usually recovers over time. That's why Warren Buffett famously advises investors to stay rational when others become emotional. The stock market has experienced wars, financial crises, housing crashes, global pandemics, and countless recessions. Yet despite every one of those events, it has continued growing over the long term. Not in a straight line, but with patience. It has always rewarded investors who stayed invested. The biggest enemy of compound interest isn't the market. It's panic. Because the moment you sell during fear, you interrupt the compounding process. Imagine planting a tree, watering it for years, and then cutting it down, just before it begins producing fruit. That's exactly what panic selling does. Years of patience, destroyed in a single emotional decision. But fear isn't the only problem. There's another enemy, one that's much quieter and much more dangerous. It's called lifestyle inflation. The moment people receive a raise, they upgrade everything: A bigger house, a newer car, more expensive vacations, luxury watches, designer clothes. Every increase in income creates an increase in spending, so even though they earn more, they never actually become wealthier. Their paycheck grows, but their investments don't. Millionaires often do the opposite. Instead of increasing their lifestyle first, they increase their investments first. They let assets grow before upgrading their lifestyle. That's one of the biggest differences between looking rich and actually becoming rich. And once you understand that difference, you begin seeing money in a completely different way. So, if emotions are the biggest obstacle, how do millionaires stay disciplined for decades? The answer is surprisingly simple. They don't rely on motivation. They rely on systems. Most people treat investing like a decision they have to make every month. Millionaires remove the decision completely. The moment they receive a paycheck, a portion of that money automatically moves into investments. Before they buy a new phone, before they plan a vacation, before they even think about spending, they pay their future selves first. This habit may sound small, but over 30 or 40 years, it can create an extraordinary difference. Because consistency always beats intensity. Investing $300 every month for 30 years is usually far more powerful than investing $10,000 once and never investing again. This is why wealthy families rarely chase the next hot investment. Instead, they continue buying assets, month after month, year after year. No excitement, no drama, just consistency. And when those investments begin compounding, they become incredibly difficult to stop. Now think about the companies behind those investments. Businesses like Apple, Microsoft, Amazon, Nvidia, and hundreds of others. Every year, these companies continue building new products, earning profits, and expanding around the world. As those businesses grow, their shareholders grow with them. That's why many wealthy investors prefer broad index funds instead of trying to guess which single stock will become the next big winner. They don't need to predict the future. They simply own a small piece of America's strongest businesses, and history has shown that over long periods, those businesses have continued creating enormous value. This is also why trying to time the market usually fails. Many people spend years waiting for the perfect moment to invest. They keep asking, what if the market crashes next month? What if prices fall tomorrow? But here's the reality. Nobody, not economists, not billionaires, not even professional fund managers, can consistently predict the market. The people who build lasting wealth don't wait for perfect timing. They stay invested through good years, bad years, booms, and recessions, because they know something most beginners don't. Time in the market is almost always more powerful than timing the market. And that's exactly why compound interest has created so many ordinary millionaires. Not because they were financial geniuses, not because they were lucky, but because they stayed patient, while everyone else kept chasing shortcuts.
And that's the lesson almost everyone misses. People spend years searching for the perfect investment, the perfect stock, the perfect cryptocurrency, the perfect time to enter the market. But in reality, wealth isn't built by finding something perfect. It's built by repeating simple actions for an incredibly long time. Think about brushing your teeth. Doing it once changes nothing. Doing it every single day for decades changes everything. Investing works exactly the same way. One investment won't change your life. 1 month won't change your life. Even 1 year probably won't change your life. But 30 years absolutely can. That's why becoming wealthy isn't usually about intelligence. It's about discipline. It's about doing something incredibly ordinary for an extraordinarily long time. Unfortunately, our brains hate that idea. We want excitement, fast results, instant success. We're surrounded by social media videos showing people becoming rich overnight, luxury cars, private jets, million-dollar lifestyles. But what those videos rarely show are the 20 or 30 years that came before them. Because real wealth is usually boring. There's nothing exciting about automatically investing every month. There's nothing glamorous about ignoring market headlines. There's nothing viral about patiently waiting 20 years. But that's exactly what works. The world's greatest investors didn't become successful because they made hundreds of perfect decisions. Most became successful because they avoided a handful of terrible ones. They didn't panic during crashes. They didn't stop investing during recessions. They didn't chase every new trend. They simply stayed consistent while everyone else kept changing direction. And that's why compound interest feels almost magical. Not because it breaks the laws of mathematics, but because so few people stay invested long enough to experience its full power. Now imagine yourself 20 years from today. One version of you decides to wait just one more year, then another and another, until decades quietly disappear. The other version starts today, not with thousands of dollars, not with a perfect strategy, just with consistency, month after month, year after year. Those two versions of you begin in exactly the same place, but they don't finish there. Because time quietly rewards the person who starts, not the person who waits. So if you remember only one thing from this entire video, remember this. Money doesn't become wealth because of how much you earn. Money becomes wealth because of how long you allow it to grow. Your future millionaire self isn't waiting for a bigger paycheck. Your future millionaire self is waiting for the decision you make today. Because the greatest investment you'll ever make isn't into the stock market. It isn't into real estate. It isn't even into an index fund. It's into giving your money enough time to work for you. And the best day to start was yesterday. The second best day is today.